Welcome back. U.S. tariffs on Canadian steel and aluminum are now a reality. And the Trump administration, of course, may still impose a much broader set of tariffs on Canadian goods shipped to the U.S. Our next guest says tariffs are one of the wild cards for investors this year, and that investors should consider holding defensive assets like bond and gold. Joining us now is Philip Petursson. He's Chief Investment Strategist at IG Wealth Management. As you can see, he's right in the studio. Thanks for coming in, and good morning.
Thanks for having me.
How should investors be thinking of these tariffs? They dominate the headlines these days, but we usually hear about it in context of businesses that will have to pay these tariffs or consumers that will be affected. How should investors be thinking about these tariffs?
Right, exactly. It's the wild card, as I mentioned, and you have to think of them as the unknown in a way. How long they're going to last? What's the impact on the Canadian economy or the U.S. economy? What's the impact on inflation and therefore interest rates? And so this all comes back to when we have uncertainty like this, you need a margin of safety in your portfolio. And whether that's margin of safety in the price that you're paying for stocks, a margin of safety in the yield that you're getting out of bonds, or margin of safety in a safe haven asset like gold. And so we would say, coming out of 2024, which was a great year for investors, be a little bit more cautious, be a little bit more defensive, and build in that margin of safety into portfolios.
That sounds like reducing your equity exposure, is it?
Well, we've been slightly underweight equities into 2025 ahead of the tariffs in thinking, okay, how do we get ahead of some of the headwinds of tariffs should they appear in 2025 as they have? And so earlier on, or in the fourth quarter of last year, we reduced our equity to add to fixed income. We added a little bit more margin of safety, adding that gold, a little bit more to gold in the portfolio.
I see in your notes that you favor Canadian and non-U.S. Equity markets, in particular Europe. What do you see in Europe?
Right. So we should say we still own the U.S., but at a slightly lower weight. In Europe, you are picking up attractive prices for equities. You can argue whether they're deep value or value, but we're at a point where perhaps the European economy is turning the corner. It can't get much worse. We can see things start to improve modestly, but that improvement will be bid up into equities.
What do you see in Canadian equities?
Well, similarly, better valuation than what we have in the United States. Historically, Canada trades at a bit of a discount to the U.S. This discount is a lot wider now than it has been in the last 20 years. Additionally, when you look at the sectors within the TSX, energy, metals, and financials, they stand to benefit from the environment that we're going into. So yes, we do have the tariffs on steel and aluminum, but other metals, gold being one on the precious metal side, copper being the other on the base metal side, stand to do better through 2025. Copper because of the energy infrastructure build out that we expect coming, and then gold because of the safe haven trade that we can see.
So the tariff issue doesn't cool you off on Canadian stocks. You think there's opportunity here in Canadian stocks, where in companies that sell their products outside of Canada?
Well, we think that we could see still benefits from companies that sell their products in the United States. But when we think about the impact of tariffs, I think the impact of tariffs will be worse for U.S. equities because valuation is much further stretched than what we see in Canada. What we're going to see out of the tariffs, especially in the United States, is going to be higher inflation. That higher inflation is going to lead to higher bond yields, which is going to put pressure on valuations. So you have less of a margin of safety in price in U.S. equities than you do for Canadian equities.
The Canadian dollar is at about 69 cents U.S. Right now, or 69.8, I believe, so closer to 70, but in the 69 range. You see the Canadian dollar, there it is now, live look. You see the Canadian dollar going as low as 67 cents U.S.
Exactly. When we attach a fair value model to the Canadian dollar, first, that fair value model over the last couple of years has been all interest rates, the difference between Canada and the U.S. We see the Bank of Canada continuing to cut. With tariffs, we see the Fed perhaps on pause. They might not cut at all in 2025. That is likely to continue to push the Canadian dollar lower. You model it out, and we can get to 67 cents.
So let's go back to the defensive positions you think investors should be emphasizing in their portfolios. Bonds are one. What type of bonds? And gold is the other.
Right. So with bonds, we prefer sovereign bonds right now, or high-quality investment-grade corporate bonds. I'd shy away from high yield at this point. Spreads are really, really tight. And again, coming back to that margin of safety, there's less margin of safety in the price of high-yield bonds, more so with sovereign bonds, especially U.S. dollar pay bonds, where we can pick up a couple percentage points on the currency.
And gold?
Gold is another one. Interestingly, when you look at gold, it has outperformed the S&P 500 over the last 1 year, 3 years, and 5 years. I think it's just starting to really catch a bid from retail investors. A lot of the buying has been on the institutional side or central bank side, Russia, China, India. But now that I think retail investors are waking up to the gains that we've seen out of gold and the outperformance, I think we can continue to see gold run in this market.
And by the way, let's bring back that look at futures gold, because as viewers know, there are different gold prices in the market. The one we're looking at is the actively traded contract. That's the April contract. The high on that set today was $2,968.50. The one we referenced in our newscast was the spot price of gold, which typically trades at a slightly lower price. That one has topped out today, the spot price at $2,942.68 US per ounce. Both of those are all-time record highs. Philip Petursson, thanks a lot for stopping by.
Thank you.
Philip Petursson is Chief Investment Strategist at IG.